Welcome back. Let's do some questions on secured transactions. Number 1. Under the revised UCC Secured Transactions article, which of the following events will always prevent a security interest from attaching? How do you attach? Pig, property owned, interest created, give value. Failure to have a written security agreement. Do you have to have an agreement? Or taking possession. Failure of the creditor to have possession or agreement. Failure of the debtor to have rights. Now remember we said property owned by the debtor, they have rights to it. Yeah, they have to own it or, I'm sorry, they have to own it and take possession or agreement, and they have to give value. D, failure of the creditor to give present consideration, present, past, all of that is valid. Best answer, C. Number 2. Under the Secured Transactions article of the UCC, which of the following statements is correct regarding the filing of a financing statement? 1. A financing statement must be filed before attachment of the security interest can occur. A financing statement must, well, a financing statement has to be in order before attachment? No, because a financing statement has nothing to do with attachment. You attach then. Once filed, a financing statement is effective for an indefinite period of time, provided continuation statements are filed, or timely filed. Yeah. What is it? Every 5 years, you can continue. So you can renew it every 5 years. So 2 only, B. Number 3, Gray sells computers to the public. Gray sold and delivered a computer to West on credit. West executed and delivered to Gray a promissory note for the purchase price and a security agreement covering the computer. West purchased the computer for personal use. What does that make it? Consumer goods. Gray did not file a financing statement. Is Gray's security interest perfected? All right, so we have Gray sells computers to the public. Gray sold one to West. All right, so let's see what's going on here. Gray sold it to West. All right, so Gray sold it to West. Gray is in the business of selling computers. It's inventory. West, it's a consumer good. He gave him the purchase money to buy it. He's taking the computer as collateral. What is that called? PMSI. PMSI in what? In consumer goods in the hands of the consumer. Therefore, will you attach? He attaches. Does he perfect? Automatically. Is there a loophole? Yeah, if he sells it to another person, they can't get it back unless they close the loophole. How do you close the loophole? File before he gets it or within 20 days of attachment. If this were equipment, is it automatic? No. But could he still file? Sure. Do we still have 20 days? Yes. If this is inventory, automatic? No. 20 days? No. Okay. So would he perfect? Yes. A, yes, because Gray retained ownership of the computer. Gray doesn't own it. West owns the computer. B, yes, because it was perfected at the time of attachment. Automatically, maybe. C, no, because the computer was a consumer good. Yeah, that's why it was automatic. D, no, because they failed to file a statement. That would be true, a financing statement, if it were equipment, but not for consumer goods. Best answer, B. Number 4, Mars Inc. manufactures and sells DVRs on credit directly to wholesalers, retailers, and consumers. Mars can perfect its security interest in the DVRs without filing or without taking possession if the DVRs are sold to whom? So they're saying they can perfect. Now remember, how do you perfect? Either filing, taking possession, or automatic. So he's saying we can perfect without doing this or this. What's left? Automatic. If it's what? Consumer goods. So let's come back over here. It's this example. With respect to whom could this person automatically perfect? Here, no. Here, yes. Here, no. 20-day window. Here, no, because it's inventory. Here, yes. Here, yes. You have a 20-day window, it's just not automatic. So with respect to whom? The consumers, they could automatically perfect. Retailers, no. Wholesalers, no. Consumers, yes. Wholesalers, no. Best answer, C.